There are many different methods for calculating depreciation. By far the most common of these is straight line depreciation. However, other methods do exist. We'll come back to those, but let's have a look at straight line depreciation in a bit more detail. Straight line depreciation says that the periodic depreciation expense per asset is the same each year. So if I buy an asset for 10, it's going to last me for 5 years, then I'm going to depreciate it 2 each year. Now the calculation for this is you take the cost, 10, minus the salvage value, the amount you might sell it for. In my example, that was 0. And you divide it by its useful life, 5 years. 10 divided by 5 years equals depreciation expense of 2 each period. Now, importantly, it is 2 every single period for those 5 years. It's the same depreciation expense. If we go to the other depreciation methods on the right, the big difference we see is that the periodic depreciation expense may vary from period to period. Examples here might include reducing balance depreciation method or double declining depreciation method. However, the important thing to realise is that whatever depreciation method you use, it has the same economic cost to the company. You still bought it for 10. The cash cost to your company was 10. You still sell it for 0 at the end. You got 5 years of use from it. The value that you put on it during its life, maybe one method has it valued at 4, another method that has it valued at 5, and another method has it valued at 6. Who cares? The actual economic cost to the company is the same regardless of your depreciation method. Another important thing to realise is that the accounting depreciation has no cash tax effect. Well, what does this mean? The accounting rules that you have used, maybe US GAAP, Japanese GAAP, UK GAAP, IFRS, whatever you've used to come up with your depreciation does not affect the amount of cash tax that you pay. Why is this? Because the tax authorities do not recognise your accounting depreciation. Instead, they come up with their own value for depreciation. Let's look at a depreciation example. Here we have an asset that we have purchased for 100,000. That's the cash cost to the company. I now need to work out what my depreciation expense is going to be each year. I know it's going to have a life of 5 years and a salvage value of 0. So I'll take the initial cost, 100,000, subtract the salvage value, 0, so it's still 100,000, and divide it by the 5 years. I know my depreciation expense will be 20,000 each period. So the value after year 1 will have dropped to 80,000. 20,000 has thus been depreciation that goes off to the income statement. And a similar thing happens in year 2. The value drops to 60,000 and 20,000 goes off to the income statement. And the same thing in years 3, 4 and 5. And by the end of year 5, the asset's value is now 0. So how much has been depreciated? It's the full 100,000. And what we've done is we have expensed the asset over the period of benefit. So what does that mean? Well, if you think that 100,000, let's say it was for a machine, did I use all of its value in the first year to help me produce and sell products that year? Well, no. If I had, I would have put all of its value into that year's income statement in year 1. But I only really used 1/5 of its value that year to produce products and then sell them. So that means I'm only going to put 1/5 of its value into the year 1 income statement for all those sales. And then the next year, we use another 1/5 of its value to produce products and then sell them. So we'll put another 1/5 of its value in the year 2 income statement along with the year 2 sales. And the same happens in years 3, 4 and 5. So you spread the value of the asset over the period that we've got benefit from it, i.e. 5 years worth of producing products to then sell them.